fresh China threats coming in from Trump, and that's really put in the world markets in a tizzy. In fact, a very sharp sell-off on Wall Street overnight. The Dow has swung about almost 500 points. Trump has slapped 10% tariff on China imports worth about $300 billion. Asia has been logging deep declines. So once again, we're back to square one when it comes to US and China.
You know, it's this constant flip-flop that we see from Trump, and it's definitely impacting the markets and perhaps raises a question, did they cheer too soon? You know, given the kind of run-up and the record highs we've been seeing on Wall Street, and given the fact that we didn't really see the kind of deep cut we anticipated from the Fed, our market's now in a little bit of a quandary there. So we've got US futures hitting a one-month low overnight, and we'll just talk you through some of the other major cues coming in as well on the global front. Gold, of course, went off to a 6-year high, and the yen also posting its biggest daily percentage gain. Buying coming in on the back of this news, and the US 10-year yield hitting its lowest level as well since 2016. Peter Cardillo is also joining us on the phone line this morning. Peter, good to have you with us. You know, want to get your reaction to Trump's latest move. There's still so much uncertainty in his commentary. He's saying we're slapping that 10%, but, you know, talks are still constructive. This is clearly a pressure tactic, but equity markets, of course, don't know which way to turn.
Yes, I kind of think it's a pressure tactic, and obviously I wouldn't be a bit surprised just before the talks resume in September that the president is likely to not to follow through on his threat of imposing new tariffs on Chinese goods. And so I think this is his way of trying to get a deal completed. And I think a deal eventually is going to come. I'm certainly not in the camp where many believe that there will never be a deal. No, I don't think so. I think there will be a deal. I'm surprised that it hasn't happened as of yet. But I think when it comes down to the nitty-gritty, you might say that it's gotten to be a political problem and not an actual closing of a deal.
Michael Every is also with us. Michael, what do you make of this news flow regarding, what tweet has come, and from 1st September there will be more products with a 10% bracket from China for US?
Well, I'll take the other side of the trade that the previous speaker was just putting forward, that we don't think there's a deal that can be done. We think fundamentally the US and China are on two different pages, which are not even in the same book. And we had actually been expecting that there was a serious possibility that Trump would do something like this. That said, it's not beyond the realm of possibility that he may keep the 10% on for, say, 6 or 9 months, maybe even 12 months, and then remove them just coming up to the final leg of the upcoming US presidential election to try and generate a little bit of a market lift. But, fundamentally, we don't see that there's anything that the US and China can agree on in terms of trade, because it isn't about trade. It's about geopolitics, and it's about power. And if you think of it like that, there's simply no way that the two can come to an agreement.
Peter, so at a time like this, I guess, it's that point when you got to think for yourself as to which asset classes do you diversify into. At a time when you've got gold prices which have shot up to a 6-year high, you've got the 10-year yield in the US, which has hit the lowest level since 2016. While US equities are holding out, there are always these knee-jerk reactions which are coming in. And yes, emerging markets, including India, are seeing a lot of pain. What would you tell investors to do at this juncture?
I would certainly make sure that in any portfolio there is a certain amount of gold holdings. I think that that's a very prudent thing to do. I always believe in having some insurances. In fact, I would say due to the present situation, it's probably wise to up anywhere by 5 or 10% of their present holdings. And so certainly with the fact that the global economy continues to slow and central banks around the world are beginning to ease monetary policy, I think it's a good bet to have a certain amount of cash placed into gold.
Michael, what do you think? Because markets have been trying to make sense of it and they've enjoyed a good run. But given the ongoing trade tensions, and as you said, if there is no likely resolution at the end of this roller coaster, so to say, what do you think is the best course as an investor?
Well, it depends on your risk profile, but since the beginning of the year, I've been advocating one boring vanilla trade, and it's worked out really well, which is long the US dollar versus emerging market FX, and long the 10-year US, or long treasuries, full stop. And if you've done that, it's boring as hell, but you've done extremely well. I mean, that being said, of course, you can make the argument you could have just gone into equities and ride out the bumps. And there's a view that you can do that too and just buy everything. But I think ultimately that the buy everything trade still turns into the buy the dollar and buy US treasuries trade above and beyond anything else.
Absolutely. Michael, just in light of this, and the kind of turn we've seen overnight, do you feel perhaps in this context the Fed's move was a little, in the sense disappointing, so to say, given the worries around growth?
Well, the Fed have no idea what they're doing. They haven't had any idea what they're doing for years, and they just publicly demonstrated that. I mean, you can see it from the market reaction. The shock and horror from people realizing that the Fed still thinks this is a mid-cycle adjustment, which from a domestic U.S. policy perspective, you can say may be justified, but from an international perspective, looks completely unrealistic. All they've done is underline they don't know what they're doing. And you have to say Trump is either very lucky or a fool or a genius, because by escalating tariff tension with China right now, the Fed has suddenly got the green light to push ahead with much more aggressive rate cuts, which is exactly what the market is now priced in. Yesterday, we were pricing 62% chance for the cut in September. Now it's 92%. So, that's exactly what happens when you get Trump stirring the pot.
Michael, thanks so much for taking out time for us. Always interesting views coming in there. Peter, thanks so much for joining us this morning.